The state of the American job market affects every single one of us. If you've been following the news lately, you've probably heard headlines touting low unemployment and strong job growth. But what if I told you those numbers don't tell the whole story? Let's uncover what's really happening beneath the surface. Let's start with the latest report from the Bureau of Labor Statistics. On the surface, it looks pretty good. The U.S. economy added 142,000 jobs in August, and the unemployment rate dipped to 4.2%. But to understand what's really going on, we need to look at two key surveys that the government uses to measure employment: the Establishment Survey and the Household Survey. The Establishment Survey counts the total number of jobs, while the Household Survey measures the number of employed people. The Establishment Survey shows that we've added about 2.3 million new jobs since August 2023. However, the Household Survey tells us the number of employed people has actually decreased by 66,000. How can we be adding jobs but losing employed people? The answer lies in the type of jobs being created. Over the past year, we've added 1.05 million part-time jobs, but during that same period, we've lost 1.02 million full-time jobs. What we're seeing is a massive shift towards part-time work, and this shift has serious implications. Part-time jobs often come with lower pay and fewer benefits. They're less stable, and many people are forced to work multiple part-time jobs just to make ends meet. This can lead to increased stress, less time for family, and greater financial insecurity. But it's not just about individual workers. This trend is a warning sign for our economy as a whole. Historically, when we see a sustained decline in full-time employment, it often precedes a recession. Right now, full-time employment has been decreasing year over year for 6 consecutive months. That's not a blip. It's a pattern we need to take seriously. Now let's dig a little deeper into some other warning signs that shows the job market and the economy as a whole might be in trouble. Starting with temporary jobs, these are often seen as a leading indicator of overall job market health. Because when companies are worried about the economy, they tend to cut temporary workers before laying off permanent staff, and this has been declining for 22 consecutive months. That's nearly 2 years of continuous decline in an area that's supposed to be one of the first to grow when the economy is strong. Next, let's look at the U6 measure of underemployment. This is broader than the standard unemployment rate. It includes people working part-time but wanting full-time work, as well as those who've given up looking for a job but would take one if offered. The U6 rate has reached a 35-month high. That means we have more people who are either unemployed, underemployed, or have simply given up on finding work than we've had in almost 3 years. These trends in temporary jobs and underemployment directly relate to the shift we're seeing from full-time to part-time work. They all point to a job market that's much weaker than headline numbers suggest. Remember the discrepancy between the Establishment Survey and the Household Survey? That gap has been widening for over 2 years. As of August, the difference was a staggering 4.2 million jobs. That's 4.2 million jobs that one survey says exist, but that the other cannot find actual people filling. A big part of this discrepancy comes from something called the birth-death model, used in the Establishment Survey. This model assumes that a certain number of new businesses are being created and adding jobs to the economy. In August alone, this model added 100,000 jobs to the total. But these are essentially hypothetical jobs, based on historical patterns that might not hold true in our current economic climate. This brings us to a broader concern: the overall health of our economy. We're seeing warning signs in other areas too. The Philadelphia Fed's Manufacturing Index and the Richmond Fed's Manufacturing Survey are both in recession territory. The Conference Board's Leading Indicators Index, which predicts future economic activity, continues to point towards a recession. We're also seeing a historic collapse in job openings in the construction sector, dropping from 456,000 openings in February to just 248,000 in August. This massive drop in a key economic sector further supports the idea that the job market is weaker than it appears. Another concerning statistic: net savings in the U.S. has been negative for 6 quarters in a row. The last time that happened was during the Great Recession. This means Americans are spending more than they're saving, which isn't sustainable and could lead to further economic stress. So what does all this mean for monetary policy and the Federal Reserve? Well, it puts the Fed in a tough spot. Since July's disappointing jobs report, Fed policymakers have been signaling that they plan to cut interest rates soon. On the surface, this might sound like good news. Lower interest rates can stimulate economic growth, right? But here's the thing. Historically, when the Fed starts cutting rates, it's often because we're already headed into a recession. The Fed is trying to engineer what they call a soft landing, bringing down inflation without tipping the economy into a recession. But they've never successfully pulled this off. Ever. They essentially have two choices. Continue fighting inflation with high interest rates, potentially pushing us into a recession, or cut rates and risk a resurgence of inflation. This dilemma directly relates to the job market trends we've been discussing. If the Fed keeps rates high to fight inflation, it could exacerbate the shift towards part-time work and increase unemployment. If they cut rates to stimulate the economy, it might create more jobs in the short term, but could lead to higher inflation and economic instability in the long run. So what does all of this mean for you? Well, it means we need to be prepared for potential economic turbulence ahead. If you're a job seeker, be aware that the job market might be more competitive than the headline numbers suggest. Full-time positions might be harder to come by, so you might need to be more flexible in your job search. For those currently employed, focus on job security. Make yourself indispensable at work. If you're in a part-time position but want full-time work, start looking for opportunities now, before the job market potentially tightens further. If you're an employer, recognize that the labor force is shifting. You might need to adjust your hiring strategies, considering the balance between full-time and part-time positions in your workforce. For investors, these economic signals might impact various sectors differently. It might be worth reviewing your portfolio and considering how it would perform in a recessionary environment. Remember, knowledge is power. By understanding what's really happening in the job market and the broader economy, we can make better decisions and be better prepared for whatever comes next. What do you think about all this? Does it match up with what you're seeing in your local job market? Let me know in the comments below. And if you found this video helpful, please give it a like and consider subscribing for more in-depth looks at the economy and personal finance. Thanks for watching, and I'll see you in the next video.